was something many economists were predicting: Canada's inflation rate ticking upward by 3.4% in December. The consumer price index hit 3.4. That followed a 3.1% increase in November. Gasoline prices fell on a monthly basis for the fourth month in a row, but the acceleration was largely the result of higher year-over-year gas prices in December. This report really highlights a challenge for the Bank of Canada's campaign to restore price stability. With me now is Pedro Antunes, Chief Economist at the Conference Board of Canada. Pedro, good morning. Nice to see you again. So there was a lot of expectation that this is the direction we would go in. Nonetheless, some economists are calling this disappointing. What's your take on this report this morning?
Well, I think obviously the numbers are going to be slightly volatile month to month. The good news is that if you look at inflation excluding very volatile items like oil or gasoline prices, you do see a continuous trend downward. So I think that's a good sign. I'm more concerned really around what's happening on the wage side of the economy. We're still seeing very strong wage growth. The last reading from the labor force survey in December was wages running at 5.4%. If you look at other measures of wages, they're really running between 4.5% and 5% as well. So it's not that we don't want to see people making better wages. It's just that, is that sustainable if you're aiming for a 2% inflation environment? So I think there's, yes, lots of challenges yet to get to that 2% target the bank is aiming for.
So the big question then on the minds of many when they see this report this morning is, where does the Bank of Canada go from here? Are we looking at another possible interest rate hike this year before we start to scale back?
Well, I've been saying for a long time that I hope not. I think certainly interest rates are still going to be taking a big bite out of consumers this coming year. Let's not forget that what the bank is aiming here to do is slow consumer spending, slow demand to essentially ease those pressures on mostly the labor market. And we have seen things heading in the right direction on those fronts. Consumer spending is really quite weak, especially if you look, you account for the very strong population growth that we've had. We have really declines in per household or per person consumer spending. So we're seeing the success of that as from a Bank of Canada's perspective on the economy. And I don't think much more needs to be done. I think we're going to continue to see that pain that households are going to feel from these higher rates and continued high inflationary pressures in certain segments of the economy, especially on housing affordability, rent and mortgage costs.
Do you
so
think
let's
that,
hope not. Yeah.
Sorry, do you think that there will be a cut, and if so, when?
Well, we're aiming for, certainly this depends on how the inflation environment pans out, but we're aiming for a cut over the second half of this year. Let's not forget, though, that interest rates came up from essentially 0 to 5%. They're going to start to come down slowly, and they'll only come down halfway, we think, when the bank finally settles, at what they call the neutral rate of interest. So this is going to be a very different environment in terms of interest rate costs going forward.
Pedro Antunes is the Chief Economist at the Conference Board of Canada. Thank you so much for your analysis.